no exceptions. So let's actually check. Behind the palm trees and pastel homes, some Florida cities really are correcting hard in 2026. Others are just slowing down while headlines call it a crash. The difference matters if you're the one buying or selling. Statewide, the picture is genuinely mixed rather than uniformly grim. Florida's median closed price sits around $394,000 to $396,000 in early 2026, down only slightly, about 1 to 1.3% from a year earlier, with months of supply climbing towards 7, 5, and homes taking a median of roughly 69 to 84 days to sell. Some metros in the Panhandle, like Crestview, Fort Walton Beach, are still posting solid gains of over 7% year over year, while a couple of inland metros further south have posted their own modest declines, and a handful of Gulf Coast markets are absorbing a real, multi-year correction. That's the actual shape of Florida real estate in 2026, not a single collapsing state, but a patchwork of very different local stories, with total home sales statewide actually up nearly 10% year over year even as prices cool. We're counting down 10 Florida cities using current 2026 sale price data, inventory levels, and days on market figures, not guesses. Some of what you're about to see will surprise you, because a few of these crash cities are actually holding their value just fine. Number 1. Ocala, Florida. Ocala is the one smaller market on this list with a genuinely real decline behind it. Redfin's February 2026 data shows a median sale price of $275,000, down 5.2% year over year, with homes now taking 96 days to sell on average, up from 88 the year before. That's a real, measurable softening, driven by a construction boom that outpaced local wage growth in a metro built on manufacturing, agriculture, and warehousing jobs that haven't kept pace with home prices. Here's the pattern interrupt. Even with a real 5% decline, Ocala migration data shows most local homebuyers are still searching to move within the metro. Not flee it, this is a cooling local market working through oversupply, not a mass exodus. Redfin's own migration analysis found the majority of Ocala homebuyers in recent months were searching to relocate within the same metro area, while incoming interest from buyers in Miami, Orlando, and out-of-state markets continued at a modest but steady pace. That combination, a real price drop alongside continued inbound interest, looks far more like a market resetting to a sustainable level than one being abandoned. Ocala's price per square foot has actually held nearly steady, down less than 1% year over year, which suggests the decline is concentrated in a specific segment of larger or newer construction homes rather than spread evenly across the whole market. Number 2. St. Petersburg, Florida. St. Pete gets cast as a coastal disaster zone in almost every Florida crash video, and the current data flatly contradicts that. The broader Tampa-St. Petersburg-Clearwater metro posted a 2.5% year-over-year price gain in early 2026. One of the stronger performers among major Florida metros, according to House Canary's regional analysis. Individual listings show St. Petersburg's median sale price actually up double digits year over year in some readings, even as days on market lengthen and inventory grows. That combination, rising prices alongside rising supply, is exactly what you'd expect from a market cooling off a genuinely overheated peak rather than one heading toward distress. Here's the pattern interrupt. A market can have rising supply and a slower pace at the same time as rising prices. That's not distress. That's a market rebalancing after years of being absurdly tight. St. Pete isn't cracking, it's just no longer moving at pandemic speed. For buyers, that shift shows up mostly as more room to negotiate and more homes to actually choose from, rather than as the kind of price cutting that would signal real trouble. Analysts covering the metro describe the shift as a move toward more balanced conditions in 2026, with modest price gains and improving inventory both expected to continue rather than reverse. Number 3. Lakeland, Florida. Lakeland was singled out in earlier crash predictions as the most vulnerable city in the state. The 2026 numbers show something calmer, a median sale price around $315,000, with median list prices actually up over 10% year over year and active inventory up about 19% according to local market tracking. That's rising supply and rising asking prices at the same time, the opposite of the panic selling scenario once predicted. Days on market remain under 2 months. Here's the pattern interrupt. More listings hitting the market usually gets read as a red flag, but here it's arriving alongside price growth, not against it, which is a sign of a market that's finally loosening up after being starved of inventory for years, not one that's failing. Median list prices for single-family homes specifically climbed from roughly $340,000 to $360,000 year over year, and with inventory still tight relative to sales volume. Local market trackers describe sellers as remaining in a genuinely strong negotiating position, not the position of someone panic selling into a falling market. Lakeland's logistics and warehousing job base, tied closely to its position between Tampa and Orlando, has continued to support steady demand from workers commuting to both metros, which helps explain why price growth has held even as new supply comes online. Worth pausing here for a second. Halfway through the list, notice how many of these crash cities so far are actually showing flat or rising prices. That's not an accident. Of which cities we picked it reflects the actual 2026 data across most of the state. The genuine corrections are concentrated, not spread evenly across 10 headline cities, and that concentration is exactly the piece a countdown video built for maximum alarm tends to leave out. Number 4. Jacksonville, Florida. Jacksonville's inventory has genuinely grown, and its logistics and shipping-heavy economy has felt real pressure, but the price data doesn't show the correction that was predicted. Redfin's data through May 2026 puts Jacksonville's median sale price at $305,000, up 0.9% year over year, with homes selling in about 60 days, essentially unchanged from a year earlier. Some forecasts do point to modest near-term softening before stabilization, but modest and 26% overvalued disaster are very different claims. The city's median price per square foot has actually risen nearly 3% year over year, even as the overall median sale price stayed close to flat, suggesting demand for smaller, more efficient homes is holding up even as buyers get pickier about larger properties. Here's the pattern interrupt. Jacksonville's affordability, still roughly 22% below the national median sale price, is exactly why demand has held up even as rates stayed elevated. Cheaper markets have more room to absorb rate pressure before buyers actually disappear. Jacksonville also sells at a healthy clip relative to its size, with over 3,500 homes changing hands in a recent month alone, and homes still fetch multiple offers often enough that Redfin classifies the market as somewhat competitive rather than stalled. That's not the picture of a port city sliding into a multi-year correction. Number 5. Port St. Lucie, Florida. Port St. Lucie was flagged as one of Florida's most overvalued markets, and affordability pressure here is real. Median household income sits well below what's needed to comfortably afford the area's mid-tier homes at current rates. Florida Atlantic University's Affordability Index has repeatedly listed Port St. Lucie among the state's most stretched markets relative to local incomes. And that pressure hasn't disappeared just because prices have held roughly steady. But House Canary's regional data shows Port St. Lucie's price roughly flat, up about 0.9% year over year as of early 2026, describing it alongside several other Florida metros as neither falling sharply nor appreciating meaningfully. That's a market in a holding pattern, not a freefall. Here's the pattern interrupt. An overvaluation warning is a statement about long-term risk if incomes don't catch up, not a prediction of an imminent price collapse, and so far, in 2026, the collapse hasn't shown up in the actual sales data. Redfin's own pricing tier breakdown shows Port St. Lucie's median household income actually running higher than the national figure, even if it hasn't fully kept pace with the area's steep 2021-2022 price run-up, which is a very different situation than a market with no buyers left at all. Starter tier homes here, in the roughly $290,000 range, remain broadly in line with national starter tier pricing, which undercuts the idea that Port St. Lucie buyers across the board have simply been priced out. Number 6. Fort Lauderdale, Florida. Fort Lauderdale is a genuinely interesting case because the slowdown is real even though the price collapse isn't. Once one of the tightest, fastest-moving markets on Florida's coast during the remote work boom, it's now firmly in buyer's market territory by the numbers. Redfin and other trackers show a median sale price hovering between $580 and $600. 000 in 2026, flat to slightly up year over year, but homes are now sitting for 105 days on average, with roughly 7 to 8 months of supply squarely a buyer's market by any standard definition. Here's the pattern interrupt. Rising days on market and rising supply usually get bundled with falling prices in these videos. But here prices have simply held steady while everything around them slows down. That's a market where sellers are losing leverage and negotiating room is opening up for buyers, without home values actually giving back ground yet. Condos, which make up a large share of Fort Lauderdale's inventory, are trading around $428,000 on average, while single-family homes sit closer to $700,000 to $580,000, depending on the reading, used a wide enough range on its own to show how much a single median figure can hide. Sales volume has held roughly steady year over year too, meaning the slowdown here is really about pace and negotiating power shifting toward buyers, not about demand actually drying up. Number 7. Tampa, Florida. Tampa shows the clearest example of how a single number can tell two different stories depending on which one you grab. City-level data shows Tampa's median sale price around $443,000, down roughly 4% year over year, with days on market stretching to 41 from 36. But zoom out to the broader Tampa-St. Petersburg Clearwater metro, and prices are actually up 2.5% year over the same period. Here's the pattern interrupt. Both of those numbers are real, and both come from legitimate sources. The difference is geography, not contradiction. Tampa proper is cooling mildly, while its surrounding suburbs pull the metro average up, which is exactly the kind of nuance that a single dramatic percentage in a crash video is built to erase. Insurance costs and property taxes genuinely have climbed here, and that pressure is real for anyone budgeting a purchase, but it's showing up as a slower, steadier market rather than the kind of panic selling collapse that would actually move the median price down by double digits. Statewide, Tampa's 2.5% metro-level gain actually puts it ahead of the overall Florida median, which is a genuinely awkward fact for any script arguing Tampa is the epicenter of a statewide collapse. Number 8. Sarasota, Florida. Sarasota North Port is one of the genuine soft spots in the state, alongside Cape Coral, according to multiple 2026 market analyses that flag the Gulf Coast as home to Florida's deepest corrections. The luxury waterfront segment that drove Sarasota's headline-grabbing 2021-2022 boom has cooled the most, as the pool of affluent out-of-state and retiree buyers who fueled that run-up has thinned alongside stock market volatility and elevated mortgage rates. Local market reports describe steady underlying demand for well-priced single-family homes even as buyers grow more selective and sellers get more realistic with pricing, alongside a meaningful rise in days on market and inventory returning to more historically normal levels after the pandemic-era squeeze. Some individual luxury listings have come down sharply from their 2022 asking prices, which is where the scariest single-property headlines tend to come from, but those are the most exposed, highest-priced properties in the market, not a representative sample of what a typical Sarasota buyer is actually experiencing. Here's the pattern interrupt. Correcting and collapsing aren't the same word. Sarasota's luxury coastal segment is absorbing a real, multi-year reset in demand from out-of-state buyers, but sales activity and pricing on typical single-family homes remain considerably steadier than the video-friendly headline numbers suggest. Builders in the surrounding Lakewood Ranch area are leaning on incentives like closing cost credits rather than deep price cuts to keep deals moving, which is a sign of a market adjusting its tactics, not one in free-fall. New construction timelines here still run 9 to 12 months, which isn't what you'd expect from a builder trying to unload inventory in a genuine panic. Local agents describe current inventory levels as having returned to more historically normal territory after the extreme scarcity of the pandemic years, a framing that reads very differently from collapse even when the underlying price trend is genuinely downward. Only 2 cities remain, and they're the 2 where the correction is genuinely real rather than a media exaggeration, which is worth sitting with for a second. Out of 10 Florida cities picked specifically because they were flagged as crash risks, only 2 hold up as clear, well-documented declines once you check the actual numbers. That ratio alone should tell you something about how these lists usually get built. Number 9. Fort Myers, Florida. Fort Myers is grouped with Cape Coral as one of the 2 metros absorbing Florida's most significant price corrections in 2026, according to regional forecasts, and the underlying causes are well documented rather than mysterious. This Gulf Coast city saw home values climb more than 65% between 2022 and 2024 during one of the hottest local runs in the entire state, which makes the scale of the current pullback less surprising in context. Markets that appreciate the fastest tend to give back the most when demand normalizes. Rental demand has softened alongside slower tourism growth, and some short-term rental investors who bought at the top are now among the most motivated sellers in the metro, accepting deeper discounts to exit positions that no longer cash flow the way they once did. Years after Hurricane Ian, damaged inventory has continued coming back onto the market. Insurance costs in the region remain among the highest in the state, and a construction boom during the recovery years added supply faster than demand could return. Here's the pattern interrupt. This is one of the only cities on this list where the overbuilding plus insurance crisis story genuinely matches the data, but even here, forecasters expect the correction to stabilize by 2027 rather than deepen indefinitely, which is a materially different outcome than the open-ended freefall these videos usually imply. Buyers who can stomach today's insurance costs are actually finding real leverage here for the first time in years, with builders competing hard on incentives and resale sellers increasingly willing to negotiate rather than hold out for 2022-era offers. The metro's reliance on tourism and construction as core industries without much economic diversification to fall back on is a real structural weakness worth acknowledging, but a weakness in the local economy is a different claim than a market in active freefall with no floor in sight. Number 10. Cape Coral, Florida. The steepest, most consistently documented decline in the state, and the only city on this list where nearly every source agrees on the direction and rough scale of the drop. Adam's first quarter data shows Cape Coral posting the sharpest price decline of any major U.S. market it tracks, with broader annual estimates putting the drop at roughly 9 to 10%. The causes are concrete: a wave of post-pandemic overbuilding that more than doubled active listings in just a couple of years, insurance premiums driven up by repeated hurricane exposure and often running into 5 figures annually, and out-of-state investors exiting positions they can no longer justify holding once appreciation stalled out. Here's the final pattern interrupt, and it's the most important one on this whole list. Even in Cape Coral, the true worst case in Florida, sales volume is actually rising as buyers respond to lower prices and more willing sellers, meaning the bottom of this correction is attracting real demand, not the kind of buyer strike that defines an actual market collapse. Builders here are now offering meaningful price cuts and closing cost assistance to compete with a glut of resale inventory. And while that's genuinely painful for anyone who bought at the 2022 peak, it's also the exact mechanism that eventually finds a floor sellers adjusting to meet buyers rather than buyers disappearing entirely. Waterfront, Gulf access properties have held up somewhat better than the rest of the market, still commanding a premium even as the broader correction plays out around them, a reminder that even inside the state's steepest decline, not every segment is moving in the same direction at the same speed. So here's the honest read on Florida in 2026. Two Gulf Coast metros, Cape Coral and Fort Myers, are working through a real, well-documented correction driven by overbuilding and insurance costs. Sarasota North Port is close behind, and Ocala has a smaller but genuine decline of its own. Everywhere else on this list, Fort Lauderdale, Tampa, Jacksonville, Port St. Lucie, St. Petersburg. Lakeland prices in 2026 are roughly flat or even modestly higher, even as inventory rises and homes take longer to sell. That's not the same story as 10 cities crashing in unison, and pretending otherwise flattens a genuinely uneven, genuinely local market into one scary headline. Statewide, inventory returning to more normal levels after years of scarcity is arguably a healthy sign for a market that spent the early 2020s badly starved of listings, not evidence that the whole state is unraveling. If you're deciding whether to buy, sell, or wait anywhere in Florida this year, the city matters far more than the state does. And honestly, the specific neighborhood matters more than the city. A single statewide number or even a single city-level median can mask enormous variation between a coastal luxury segment cooling off a genuine bubble and an inland starter home market that never really overheated in the first place. Pull the actual local numbers for wherever you're looking before you make a decision based on a single scary percentage from a video, including this one.